Assalamu alaikum friends, welcome to day 9 of AFM revision crash course. Today we are going to introduce you to risk management. So what are we going to cover today? We are going to go through the past exam history, risk framework, specific types of risk, political risk, economic risk. So these are the some specific types of risk. For example, political risk, economic risk, regulatory risk, fiscal risk, credit risk, value add risk. We are going to talk in detail about this type of risk because in your exam you need to know different types of risk to discuss. It's not just only the uh, business risk or your financial risk. So coming to the past exam history, if you see value at risk, usually value at risk we study under investment appraisal, but you can use it in risk management as well. It's a risk management technique to manage your risk, and this came twice in question number 2. Sensitivity, right? Risk management discussion, if you see, it came most of the time in question 1 or 2. So risk management discussion, you should know to discuss the risk management techniques. What are the specific types of risk? How do you uh, hedge different types of risk or mitigate different types of risk? Simulation discussion. Then we have derivative market technology, example margins. Okay, margins and all we have in the future. In the future derivative, we have margins. So that came as question number 2 in December 2018 once. Now let us go to the risk framework. Every organization needs to have a risk framework. Okay, why do we have risk framework? Because there are projects which are risky, and risk can be of any types. Strategic, for example, long-term risk, tactical, medium-term, operational, that means day-to-day risk. Okay, now a risk framework needs to cover two things. One is risk awareness. It makes you aware of the risk. Okay, this is a formal risk assessment is needed, especially for those area where you are using estimates. Okay, and those estimates are very material because those risks can affect your project as well as your profitability, right? For example, if you are taking an investment, right? An investment is a long-term project, so risks are heavy, and that project you are not going to cover in 1 or 2 years. It takes number of years to cover that project. That's why risk is heavy in this area. That's why we need to have a formal risk assessment for this. And this question, this video, whatever we are going to cover in this, mostly this will be in your theory part of AFM. Okay, you can write these answers in your theory part. We are not going to cover calculations here. We are going to cover calculations tomorrow when we are introducing you to the foreign exchange risk management. Okay, today we are just going to go through the theory part. Then we are going to do second thing that a risk framework needs to cover is risk monitoring. Okay, when a risk rises above a certain level, you have to take action. Okay, it alerts the management before it's too late. Now, there are strategies that you need to know to deal with risk. There are 4 strategies that you can do. Number 1, you accept the risk. Number 2, you mitigate the risk. Mitigate means you are taking some action to mitigate the risk. You're taking preventive actions and all. Then hedging the risk. Hedging the risk comes after you have put the control, right? You have tried to prevent the risk, but it did not happen. Still there was a risk. Now you're trying to hedge that risk. And diversification. In SBL, there's a model for this risk management which is known as TARA model. TARA stands for transfer, accept, reduce, and avoid. Okay, so here also is the same thing. Accept means you are accepting the risk. Mitigate means you are reducing the risk. Mitigate means you are eliminating the risk. Hedging means you are reducing the risk. Okay, and diversification means you are transferring the risk. Now let us go into the detail what is mitigation, hedging and diversification, because they are different. Okay, the meanings are different for each. They are not the same thing. What is mitigation? Mitigation usually happens uh, when you're trying to prevent a risk from happening in the first place. Okay, you're trying to identify and deal with the risk before they become problematic. Second, management should implement this control, especially for more material risk. But remember, when you're putting controls, the benefit of the control should be more than the cost of putting the control. Number three, for non-routine event, you can have a strategy for dealing with the risk. Remember, not all the risk that you are incurring, whether foreign exchange risk or interest rate risk, you're not hedging all the risk. Sometimes you might have to accept the risk. Sometimes you might have to diversify the risk. Sometimes you might have to mitigate the risk. So you need to have a strategy depending on the type of the risk. Okay. Now we are going to go in the hedging. Very important for your AFM, because mostly the type of risk that we are doing is hedging only. We are using all the derivatives to hedge our risk, whether foreign risk, whether interest rate risk, using various derivatives, right? Options, swaps, and all that we'll cover tomorrow in detail. So hedging means you are trying to eliminate or reduce the risk. Next, hedging can be in a form of derivative. That means either you are buying a derivative security or you are selling. For example, you can buy options, you can sell options. You can buy future, you can sell future. Okay. A perfect hedge will eliminate all risk, right? Perfect hedge means what? Risk will be totally gone. Zero risk. But remember, if the risk is zero, future gain also will be zero. Because risk and return behaves in the same way. Higher the risk, higher the return. So if no risk, no return. Next, strategy. So when you're choosing the strategy of hedging, you have to see that the cost of the hedging should be less than the benefit of that hedging. It's outweighed by the benefits of certainty, because all these hedging instruments that you are using, derivatives, to hedge, what are they doing? They are just giving you a certainty of the future. That if your foreign exchange risk moves unfavorable, at least you are certain that you are going to receive this much of payment or this much of receipt you are going to receive. It's giving you a certainty. So you have to weigh the benefit of certainty versus the cost of the hedging instruments, which is more. If the cost of hedging is more, you're not going to hedge it. If the cost of hedging is not more compared to the benefit of the certainty, you are going to hedge. Okay. Now we are coming to the diversification. Another thing about hedging is this is mostly used when downside risk, because sometimes when the risk is going downside, risk means it can cause a large negative consequences for the firm. Downside risk means risk is increasing. Okay. If the risk, if you're happening, if there's a risk, but that risk is not causing such a huge impact, such a huge negative impact, then you can accept it. Okay, then you might leave it unhedged sometimes. So it depends. Now let us go to the diversification. Diversification means you are not putting everything in one basket, you are spreading out, so that you're not dependent on one supplier, one customer, one market, right? One geographical location. You are using multiple geographical locations now. You are using multiple suppliers now. So that if you're having a negative impact in somewhere, the positive impact from the other will minimize the impact of the negative impact, right? It will be net off against each other. Next, specific types of risk. What are the specific types of risk? We have some 4 to 5 types of risk. As well as being aware of the business risk and the financial risk. See, in AFM, you definitely have to know the business risk, because asset beta and everything we have to calculate. This financial risk also you have to know, because capital structure changes, financial risk will change. Gearing, right? These issues are covered everywhere in your syllabus. But other than this, you have to know some other types of risk. One is political risk. Then we have economic risk, regulatory risk, fiscal risk, credit risk. So these are the type of risks that you need to know. I need to write in your answer also, especially in question number 1 for report. When you have to make a report, right? When you have to discuss whether you are going to take this investment or not, you have to take care of these things also. Whether that investment has a political risk, whether that investment is giving you an economic risk, other than your calculation. Okay, when you're calculating, you definitely can talk about business risk and financial risk. But this type of risks, they are not quantitative; they are qualitative type of risk. You cannot measure it, you cannot calculate it. So you need to use a scenario to see whether there's a political risk or not. Okay. So let us go to the political risk. What is political risk? Political risk is any risk that is caused by the government. If the government takes any action, adverse action against your project. Okay. The host country government. That is known as host country government, where you are doing business overseas. In that country, that country's government will be known as host country government. Okay. So, for example, some examples of political risk are: government can impose regulations. The foreign government can impose regulations on your project by having exchange control or company structure. They might tell you that you cannot remit the fund to the parent company. So it's limited. They are limiting the remittance. They are keeping the remittance there itself. They are not letting it to go to the parent company, your company. Discriminatory actions against foreign firms. Yes. They might discriminate the foreign firms against their local firms, which is a political risk again. And severe political unrest or war. Whether these risks are there or not, how will you understand? You have to use the scenario. In the scenario, they will give you information about it. For example, they might say the government is unstable, the government is not performing well over the years, there is a war going on. Some things they will say like this. Hint will be there for you to identify. Now, how do you manage the political risk? You can either accept it, okay, you measure it first, and then you can either ignore it, okay, or you can negotiate with the host country government so that you can minimize the impact of the political risk. Even if the government imposes any changes in the rules, you can negotiate beforehand so that the impact on your business is minimized. For example, concession agreements and planned divestment. Okay. Then structuring investment. You need to structure your investment. How? Local sourcing. You source locally. Location of facility. When you're choosing the location, you need to choose in a location where the government is stable. Okay, where there is no war going on, no corruption is accepted. Then control of distribution. How do you have the control to distribute? Control of technology. Are you having the technology in that country? Financial measures. You need to structure in such a way where you have the control of technology, you have the control of distribution. Financial measure, organizational measure. Now let us go to economic risk. Economic risk also same like political risk. It will be given to you in the scenario. You need to find out. So economic risk is when your business value is changed due to changes in exchange rate. It could be anything: exchange rate, interest rate. Okay, all these things are causes of economic risk. See, anything in the economy, if it changes, means it's an economic risk. For example, exchange rate, interest rate. These are not in your control. It is beyond your control. Okay, exchange rate changes, interest rate changes, tax increases. All these are form of economic risk, which can affect the value of your business. It can impact on the competitiveness as well as your profitability. Firms can mitigate this type of risk, or at least they can try to mitigate by diversifying. Example, if they are facing currency issue, right? Foreign currency issues with the overseas, they might go to some other country where the government are more stable, where there's a favorable foreign exchange rate. In that way, they are diversifying the risk. Long-term transaction risk, yes. Economic risk can give you long-term transaction risk. Then it can be defined as the risk arising from the changes in economic conditions. If any changes happens in the economic, it is known as an economic risk. Okay, usually this type of risk are long-term. Regulatory risk. So regulatory risk means when there's any change in laws in that country. Okay, because this can have an impact on how you are operating the business, how you are doing the business. Are you complying with the laws or not? So based on this, it will affect your investment. Are you going to invest there or not? Now, another risk is compliance risk. This is related to regulatory risk. Okay, compliant risk means you are not complying with the law. There's a risk that you're not complying with the law. So if you're not complying, you are going to suffer losses, penalties, fines, and all those things. Okay, and this type of risk can be general or specific to an industry. Okay, general means every entity has to is having that risk, regulatory risk. Everyone has to follow that law. Specific means some industries has some more specific rules. For example, if you take insurance fund, okay, insurance company has more specific rules for that company. They are more tight. which is not general for other industries. So they need to make sure they are following the general as well as the specific rules also. Okay. And firms need to manage this regulatory risk, but often it is not managed. Okay. This type of risks are often not managed, but you have to make sure that you manage the regulatory risk. Then this both are combined, regulatory risk and compliance risk. They come together. Because if you're not complying with the risk means it's a regulatory risk. You're not complying with the law. So they both are associated with each other. They go hand in hand. Then we have fiscal risk. What is fiscal risk? Fiscal risk means when the government changes their fiscal policy. This can affect the present value of an investment. Okay. For example, government might increase the tax. Government might reduce their spending. Right? What are the fiscal policies? Either government can reduce the demand. Okay. They can reduce the government spending or they might increase the tax. So through these two ways, they can manipulate their fiscal risk, fiscal policy. So if they increase the tax, okay, it's going to affect on the investment project. No one will go and invest in that country. Changes in the tax rules, as I told before. That's why changes in the tax rule, because tax is one type of fiscal policy holding. Government try to manipulate tax rule. They try to control that tax rule. So that's why you need to monitor when the tax rule changes. In the scenario, it will be given, okay, whether tax rules are changing or not, whether government is stable or not. Credit risk. Credit risk means when there's a risk that the lender will not, sorry, the borrower will not be able to pay the lend. They will default on their payment, whether it is interest or whether it is the principal amount of the loan at the due date. This is something very easy. Credit agencies often gives a credit ratings. For example, one credit agency is very well known as Standard and Poor. They can help in this to know the credit risk by assessing such risk. They will give you a credit score. If you are having a good score, if you are having a good rating, for example, triple A bond is considered better, it is rated better compared to single A or triple B, right? All these are some ratings which are given by the credit rating agencies. And the ratings will be given, what rating you are will be given to you in the question. And you need to calculate the credit spread sometimes to calculate the credit risk. This is usually the table will be given to you that for this year this is the rating given and this is the credit spread. Okay, this credit spread can be used to find the market value of debt, the probability of default as well as the credit spread. Okay, now let us go to the value at risk, the last section for today. Value at risk is often used by security market and all industries where risks are very, like they cannot take even a small amount of risk. Even a 0.005% risk is also considered very material. For those type of businesses or industries, this technique is used. So value at risk means they measure how much the market value of an asset changes. It will decrease over a certain period of time, usually 1 to 10 days, okay, under normal market conditions. But you don't have to know those days and all those things. You just have to know when it is the decrease in the value of the asset, market value of an asset. So value at risk measures that how much it's changing. Then this is measured by using normal distribution theory. Then it is typically used by whom? As I told you, security houses or investment banks. Investment banks also use this technique to measure the market risk of the asset portfolios. And another industry which uses this technique is airline industry. Because airline industry, they need to be very careful, they need to be very precise in their measurements on all, at what altitude they are flying, at what time they are going to land. They cannot take any risk, because if there is a 0.0001% risk is also there, failure somewhere, it can cause a death, right? It can cause a loss of life to someone, because that area is very risky. So that's why they are measuring that at 5% confidence level, what is the risk. At 10% confidence level, what is the risk? Sorry, 95% and 99% confidence level. For further reading, you can have on your ACCA website, there's a technical article named as risk management. So risk management addresses these issues that we have covered today. Okay, so make sure that you go and read. And I will see you tomorrow in hedging foreign exchange risk, where we are going to cover all types of hedging instruments relating to exchange risk only, not interest rate risk. Interest rate risk will be later after that. Okay, for example, options, swap, forward, money market, future. So till then, take care and don't forget to subscribe to my channel.